Good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. We've had a really interesting, week or 2 weeks in the markets and in the economy with some major changes that really have come out of nowhere. I don't think a lot of people were expecting it. And I wanted to check in with a gentleman that I've had the privilege of interviewing before. John Rapley is his name. Who's the managing director of a company by the name of Seaford Macro. He is also associated with the University of Oxford in the United Kingdom, but I think he's actually coming to us today from South Africa, which is quite interesting. He's an award-winning academic, author, and macro analyst with a focus on applied research in geopolitics, global political economy, and policy studies. Welcome to the show, John. Again, thank you very much. You wrote just a couple of days ago about the Silicon Valley Bank and how its collapse. We shouldn't have been. We should have been expecting, and you're saying it's part of our collective delusion. Can you explain that?
Well, I mean, at the end of the day, because it begins with money and our faith in money. And money, people think of money as something physical. Most people, if you ask them what money is, they will think of banknotes or bank coins, and they sort of picture going to the bank and the teller opening a drawer and pulling out, some cash. And we still have this idea that there's a vault somewhere at the back where all that cash is stored. But in fact, almost none of the money that we use ever takes that form. A very small percentage. Money is something that is essentially a social contract. It's a promissory note. It entitles you to somebody else's labor or resources at some point in the future. And it all depends on our belief in two things. One is that the banks which mediate these transactions will actually be able to honor them when the time comes, and that the money itself will effectively exist, that the central bank itself will guarantee that that money is usable. Because when that faith is lost, this has never happened in Canada, but it's happened in a number of other countries where people stop believing in the currency altogether and stop using it, and they substitute other forms of currency. Whether they use foreign currency or they use other forms of instruments to sort of transact.
Crypto.
And it all depends on that faith. It is, in that sense, a collective delusion. There's nothing real there, but we believe there is, and so that makes it real.
And so what you're saying is that we should have been expecting a bank collapse, or this bank collapse, or more bank collapses?
Well, the fundamental problem, as I see it, Brian, and I've been saying this for quite a while, in my articles in the Globe and Mail, is that our faith in money has been eroding because our faith in central banks has been eroding. I mean, if you look at Canada, housing prices went up in one particular year by 40%, and people think of that as an increase in value. But another way to look at it, and the way it really should have been properly looked at, is that's a loss of purchasing power of 40% of the dollar. And you look at the value of cryptocurrencies, for example. I mean, they're the biggest beneficiary in the last week of the bailout of SVB, of Silicon Valley Bank, because there is that loss of faith in fiat currencies that central banks, because they have resorted to continually flushing the economy with money, are debasing the currencies, and people are shifting instruments. That's a real crisis of faith. And I think it sort of papers over the problems that are emerging or have been there in the economy for quite some time. But it's only making things worse. At least that's what I would argue.
Well, the reason why I initially reached out to you was you wrote a really interesting article just a week or so ago in the Globe and Mail called "If the Economy Crashes, Let It Burn. In fact, we got here by intervening too much," which is the opposite of what most people think. They want the Bank of Canada to step in. They want the Office of Financial Superintendent to step in. They want the Fed to step in. And you're arguing that we're doing too much of it. We're gonna take a break for some messages and come back more in just 2 minutes with John Rapley and ask him why he wants the economy to burn. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. We've had really quite a tumultuous a week or two in the financial markets. Some concern with the banking sector for the first time in, 12 years or so, that bank regulators in Canada, the United States, the Great Britain, Switzerland, et cetera, have moved in to save banks. And John Rapley my economist guest tonight, actually wrote an article that said that if the economy crashes, let it burn. In fact, we got here by intervening too much. That's a pretty contrarian point of view, is it not, John?
Well, it's certainly contrarian. The thing I should actually specify, just be clear, the headline didn't quite convey what the article conveys. I'm not suggesting the economy should burn. What I'm suggesting is that markets should be left to burn. And that would actually be good for the economy. That would actually lead to a more efficient allocation of resources. So who are the people who are calling for intervention? It will be either asset holders or those who sort of work for asset holders who will say this is going to be a crisis that is going to blow up the economy. But many people in the economy would actually benefit. If you took Canadian house prices, for example, I mean, an awful lot of people would stand to gain if house prices came down. My argument too, though, is it would lead to a far more efficient allocation of resources in the economy than we're seeing. There's not been enough investment in raising labor productivity in Canada because so much money has been going into housing. Moreover, that has locked in the inflation problem we're now dealing with. Workers, after several years of having their wages beaten down, have regained bargaining power in recent years. That was a trend that was building several years ago, and it's now manifest clearly. And they're starting to demand, rightly, to get compensation that makes it affordable for them to live. And one of the ways in Canada this is showing up, as in the United States, is that I believe I'm correct in saying now real wages have just turned positive. They have in the United States. I think they have in Canada. Workers are gaining earning power. And that is then, however, locking in price inflation and forcing the central bank to raise interest rates, which will knock down asset values. That was something that should have happened years ago. The central bank, the Bank of Canada, was pumping money into the economy for far too long, and we're paying the price for that. And this is now, we're seeing the fallout of their rapid attempt to sort of backpedal and to roll back that loose monetary policy, but they left it too late, and it's going to be very painful, as we're seeing. This is just the start of what will probably be a rolling crisis.
So I interviewed an economist last week that argued that central banks should have two objectives. One is inflation. The second one is employment. Are you arguing that they need a third, which is what, reasonable asset prices or not unreasonable asset price growth?
Well, no, I think we need to factor in which economic models used by central banks don't. We have to factor in asset price inflation. Their argument is they use a conventional neoclassical model, which is that asset prices don't work their way into the real economy. Therefore, we don't have to factor them into our consideration of inflation. My argument is that asset price inflation does work its way into the real economy. It does so with a lag. But we are seeing that lag play out. The problem is because so much asset price inflation was stored up over the last decade, it's going to lead to, or it will now lead to this persistent inflation. Inflation won't come down to the targets central banks are setting. And that means that interest rates will stay higher for longer. Now, that won't necessarily be bad for the economy, but it will be bad for those who rode that asset price boom. And they've got, right now, central banks are trying to manage, and they're not doing a very good job of it. Certainly, the Fed isn't doing a very good job. They're trying to choke off consumer price inflation, but in the process, they are making some banks very vulnerable to a shock. And every time that happens, as they've done, they put more money into the system, which they're going to have to pull out with the other hand. So monetary policy is working at cross purposes to itself, and it's becoming very confusing, which is, as I say, only further reinforcing this sort of sense of a crisis of faith, if you will, in the whole fiat currency system. And that's going to be a big concern for governments, for central banks, and for all of us if that continues.
So, I think one of your arguments is creative destruction. Who was it? The Austrian economist Joseph Schumpeter, who argued that you sort of let that restructuring take place, and that's creative and beneficial to the economy. Is that what you're arguing? Is like let markets do what markets should do?
Well, we either live in a market economy or we don't, Brian. I'm not suggesting that there's one particular model that is the best model. I'm not an Austrian economy myself. What I am saying is that you can't continue the system we have now, which is where when it comes to profits, we believe in the market economy. When it comes to losses, we suddenly become socialists. All these sort of libertarian Silicon Valley tech entrepreneurs who said, well, SVB did not need to be regulated, and we need to get government off its hands off our activities, and we should be left to do our own thing. As soon as they suffer losses, they're running to the government for a bailout and getting one.
I lost you there for a second.
We're passing it on to taxpayers, and we're sort of constantly transferring resources from workers to owners. And that's not a market economy. If we're going to have a market economy, we have to play by the market rules, and we have to make that choice. If we want to socialize things, then you can start talking about socializing the banks next time. Instead of bailing them out, just take them over. That would be another way of approaching this. That would be a legitimate way of approaching it. But we sort of are being inconsistent in our approach to the economy.
So that was one of the arguments in the 2008, 2009 Great Recession, is that we had, capitalism for most people, but socialism for the banks. So what are you arguing? That we should have allowed Silicon Valley Bank and Signature Bank and CSFB to go bankrupt?
Well, they have. I mean, they have failed, right? And they've been liquidated, and the shareholders have been wiped out. And that at least is an improvement over what was done in 2008. The big issue, as you know, in in Silicon Valley and Signature Bank, there were two things that were done that are highly, highly questionable. One is that in the US, deposit insurance scheme has a limit of $250,000, after which you take whatever losses. You don't lose everything you had in there, but it's after the bank's assets are liquidated, you'll take a haircut. That's the first thing that they decided not to do. They said they would guarantee the full value of all deposits. The second thing they also did, which is unusual, is they switched the accounting mechanism away from having to market the value of government bonds at par, which is to say the actual, what is the coupon issue? And so, a US government bond worth $100 is worth $100. They can get $100 for it. Whereas in mark-to-market accounting, you would basically get the value of the bond on that day. They work it out that way. Now, what that did is essentially create what we call moral hazard in economics. It's basically saying, look, take risks with money, put it into the bank will loan it, and they'll try and get the highest return for you possible. And if you lose everything, the government will cover your costs. So you don't have to worry. So that means you can take the greatest risk imaginable. Now, I think that particular decision was a very, very bad decision. Both of those, but in particular the one of guaranteeing the full value of deposits, because there's no evidence that the firms that were losing money and the investors that were losing money couldn't have absorbed what would have been a haircut. They took the chances, and those are the rules they play by. Instead, now, the Treasury Secretary, I don't know if you saw her testimony before Congress yesterday, but it was pretty disastrous. And does this mean now that all banks are going to be rescued? And her answer essentially is, well, we'll play it, each one will take in turn and we'll look. Which means that the entire network of regional banks is creating a panic in the US, because investors are saying, well, is my local bank going to shut down? Let me withdraw the money and put it into Goldman Sachs or one of the big banks where it's going to be safe, where I know the government will bail it out. And this is going to create all sorts of political difficulties as well as economic difficulties in the United States. And then the third thing that they just did very badly is they regulated very badly. I mean, the warning signs were clear that Silicon Valley Bank was going to enter into trouble, and the Fed was completely asleep at the switch this time. So it's an egregious failure on the part of what's the most important central bank in the world. And as I say, the problem is it's just storing up problems that we're going to deal with for quite some time.
So do you think that they're going to have to save every single bank that teeters on collapse? Is that
it's going to be very
precedent?
It'll be very difficult for them now to avoid doing so, because politically it will be toxic. If the Treasury Secretary was being interrogated by a congressperson from Oklahoma, and who was raising this question: are you going to let my local bank in Oklahoma? Are you going to let it go out of business because you don't consider it systemically important, but you thought that the one in California was? And she couldn't give a clear answer. And that's obviously, as you know, the worst thing possible in economics, when it comes to forecasting, when it comes to investing, is uncertainty. Saying we'll see, we'll cross that bridge when we get to it, is not the kind of answer that depositors wanted to hear. So there is a real risk that if they don't now bail out everybody when it comes, And this brings us right back to the problem we had before, which is, well, where is all this money going to come from? It will come from continued loose monetary policy, which means that inflation, the battle against inflation, is going to be prolonged, which will both inhibit the economic recovery and also store in inflation. So, I mean, you're looking at a decade of, or at least several years, if not stagflation, of pretty anemic growth and persistent inflation. And that's the worst possible combination for a central bank to bring about.
So I heard from several different financiers this week that they thought that this was different because Silicon Valley Bank was so critically important to the venture capital business in Southern California, if not, frankly, the United States and North America, that something like 50% of all the VC firms in Silicon Valley actually had deposits, if not investments, in Silicon Valley Bank. In fact, I had one gentleman say that it was, if this was just a regular bank in Oklahoma or wherever, it would have gone bankrupt. The Fed wouldn't have stepped in, but because it was so critically important to the VC business, and the VC sector was such a big donator to the Democratic Party, that it was a unique situation. Is there any truth in that argument, do you think?
That would be, of course, a particularly toxic combination if the reason it was bailed out was because Silicon Valley is a big donor to the Democratic Party. It's entirely possible that was one of the motives. I think it's not, I'm not terribly persuaded by the argument that there was a systemic risk and that Silicon Valley was going to collapse. We kept hearing, well, a lot of those firms are banking there that are losing everything above 250,000, firms that have lodged millions of dollars there aren't going to be able to meet payroll this month. There were solutions to that problem, because bear in mind, as I say, Brian, most of what they put in was going to come back because the investments were in very secure assets, namely treasury paper. The fundamental problem was they bought treasury paper at a time when interest rates were low. And now that interest rates are going up, just because of the way bond markets work, that brings the value of the bond down. So if you're forced to liquidate and sell the bond, instead of getting the $100 on a $100 bond, you might be getting $98. So you're making losses. But we're not talking about that $100 bond disappearing in value. You're talking about haircuts in the order of, a few dollars on every 100. Unless a firm was so close to the margin of existence that loss was going to drive it out of business, I find it implausible that Silicon Valley would have simply collapsed because they allowed this haircut to take place. As I say, I think there were much better ways to have dealt with this than what was done. And
so if you were the Treasury Secretary or the head of the Fed, what would you have done?
Well, the first thing there are a lot of things I would have done differently. Obviously, I wouldn't have been persisted in the loose monetary policy. That's the basic problem. They kept interest rates too low for much too long, and they kept quantitative easing going for much too long. So no matter how they deal with it, they've created a crisis, and now they're trying to manage it. But having created that crisis, the next thing they should have done much better. The regulators should have been keeping a much closer eye on the situation, and the politicians, who were accepting large donations from the lobbyists to lift, because the Dodd-Frank Act that was passed after the 2008 crash said any bank with assets under management of over $50 million was systemically important. And SVB led the charge and paid handsomely, as did Signature Bank, which incidentally paid Barney Frank, the architect of that bill, something like $1 million to lobby to lift that limit from 50 million to 250 million, which meant they could operate below it and say, we're not systemically important. And of course, what happens is as soon as they run into difficulty, they suddenly say they are systemically important. Well, which is it? And this is, as I say, this is a failure on the part of the politicians. It's a failure on the part of the regulators who are asleep at the switch. And it's a failure on the part of the central bank for having created this mess in the first place. So I think, what is the solution to that? I think they got to start listening to different people, quite frankly, and not keep, I keep hearing Larry Summers on television. Larry Summers has his fingerprints all over every financial crash of the last 2 decades, and they keep running to him for advice every time this happens. They're listening to the wrong people.
So you would have not stepped in to help out Silicon Valley Bank last Sunday?
No, if I was the American regulator, I would have stepped in to begin the winding down process. I would have stepped in with, extending credit facilities as the Fed did, which made it possible for a bank to borrow money in order to be able to depositors who wanted their money could get their money, at least some of the money. But I would have certainly anything over. What's the point of having a limit saying we will only insure you over 250,000 if the minute there's a need for money above that, you just say the limit no longer applies? It's an absolutely pointless thing to do. And what are you saying to small savers? You're saying, well, it's like that old saying: if you owe the bank $100 and can't pay, you have a problem. If you owe the bank $1 million and can't pay, the bank has a problem. And what we're saying to ordinary people is that, we're never going to come and bail you out. What we will do, and this is part of the difficulty, is that the way they say they're not going to make taxpayers pay because they're going to increase the bank levy for insurance on all banks. But that means that ordinary savers are going to end up having to pay higher service charges across the board in order to cover the cost of this insurance. So ordinary people who've just, been putting aside money in their pension fund or in their home saving fund or just their rainy day fund are now going to have higher service charges in order to bail out billionaires like Peter Thiel.
So taxpayers will pay, just not directly through taxes, but indirectly through other fees.
That's right.
Sounds like socialism.
Socialism, yes, as I say, socialism of loss and capitalism for profits.
Socialism for the rich, socialism for losses, capitalism for profits, and
for everybody else,
and
right.
Everyone else in just good times. We're going to take a break for some messages and be back in just 2 minutes with John Rapley talking about both this real issue in the financial sector in the last couple of weeks, but also I want to focus back on his argument in regards to asset prices and that some restructuring out of that is not really a problem. Stay with us, everyone. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. My guest tonight is John Rapley. He is a very experienced gentleman. He's got a master's and a PhD in political economy from Queen's University. He started his academic career in political science and history at Carleton University. He got a postdoctoral fellowship at the University of Oxford. He's been a visiting professor in Germany, in South Africa, in the United Kingdom, and he now runs a consulting company called Seaford Macro. He's the managing director, but he's also a senior fellow at the Johannesburg Institute for Advanced Study. He's a frequent columnist in the Globe and Mail and other media places. He's a really smart guy, and he's a little bit controversial in some of his opinions. I reached out to him recently because he wrote a really interesting article in the Globe and Mail, and he says that the title wasn't completely accurate, but he talked about if the economy crashes, let it burn. In fact, we got here by intervening too much. And John, I guess your argument is that that loose monetary policy and low interest rates led to huge asset price increases, and in Canada, that's been primarily in the real estate market. What do you think should happen? Would you support a 30-40% decline in real estate asset prices?
Okay, can you hear me now?
Yes.
See me now? Yeah, I keep having connectivity issues here.
So, John, what do you think? Should we allow real estate prices to decline if that's what's going to happen?
I do think so. I mean, I simply can't see what the benefit to the economy is of allowing that kind of increase in house prices. Now, what's driving it? This is the big and particularly controversial issue. Everybody says there's a housing shortage in Canada. Now, it's true the ratio of housing, if you compare Canada to West European societies, hasn't increased over the last 30 years the way it has there. But I actually haven't seen any compelling evidence that there is a shortage of housing in Canada, that housing starts seem to be keeping track with household formation. What I think has happened, and this is part of the result of that decade of easy money, is you had the growth of an investor class that was buying multiple properties, and that was distorting the market. So that if everybody who wanted to, if every homeowner just wanted to buy a home, and that's the way the market was allowed to operate, I don't think we would have got to this sort of state we're in Canada. I think my understanding, from what I can tell, is that you get multiple property owners who are therefore driving up the value of the properties, which in turn drives up the cost of rent. And that is also encouraging, as I say, investors of any sort to move out of sort of productive activity and just putting into property, because the central bank has more or less underwritten your investment, and by putting more money into the economy, driving up the value of fixed assets. That ultimately affects the economy as a whole. As I say, it not only leads to, the number of new startups in Canada, for example, as in the US, has been declining. Labor productivity is not particularly strong. Research and development isn't particularly outstanding for a country at its level of development. But that's kind of logical when you think about it, Brian, because if you want to start a new business, what is the most prohibitive thing that's going to prevent you actually setting up a business? Is going to be the cost of rent. You have to generate so much income just to cover the cost of rent. And that goes for everything. If you need to hire a worker, you have to pay the worker the cost of, what a Marxist would call the reproduction value of that labor, which is to say they have to live. They have to be able to afford rent somewhere. Just to illustrate, a simple illustration, here in South Africa, you can hire a very bright entry-level economist in academic environment, in a business environment, and you'll pay them perhaps a quarter what you'll pay them in Canada. Now, the standard explanation for that is, well, they're being exploited. But in fact, if you look at their standard of living, they're going to be living better than the one that's paid much more in Canada. The reason is because they don't have to spend very much on the cost of accommodation. The money's left over for all sorts of other things. In Canada, because of the fact that the cost of accommodation is so high, that raises the price of absolutely everything else, from your groceries to your wage. And that affects the country's competitiveness. So it's not good for the economy, and certainly not good for people trying to buy their first home. So I think it's become a distorted market. And I think if, in fact, the effect of interest rate rises were to cause a sharp adjustment in property values, you would want to manage that. But my sense about that is that anybody who's an employed earner who's covering the cost of their mortgage from their salary, from their wage, because of what's happening in labor markets, and that wages are actually keeping up with inflation now, it's going to be a pinch, excuse me, but they're going to be able to manage. The people who are going to struggle are the ones who are covering the cost of their mortgage from the rental, or either flipping the property and looking to make a profit, or covering it from the rental income, who aren't able to drive up the cost, the value of their rent. That would be the investor class. But if that releases more property onto the market, that means homes become more affordable. I simply can't see why one would argue against that. The only remaining argument for keeping asset prices inflated is the so-called wealth effect. Well, people feel wealthier, they spend, that's good for the economy. But there's frankly far better ways to get economic turnover. One would be to pay workers better and have them spending less on rent. And I can't say this often enough. I say it all the time ad nauseum. Houses produce nothing. You build a house and you have a place to live, but it's not going to add to the economic output of the economy. So if we're pumping all of our money and all of our investment into real estate, that's not a sign of a healthy economy.
Really, this is fascinating. So, the former Minister of Finance in Canada has written a book, and he's, I think, one of his main theories or main thesis is that we haven't had any productivity growth in the last decade or so in Canada. We don't have a growth agenda, he argued. And what you're arguing is that that's because, number one, we've crowded out investment that would have gone into the productive economy by spending all that cash on real estate. And number two, we're making any kind of business more inefficient and more expensive to launch because of the cost of rent. This is really kind of interesting. Let me ask you though, one of the reasons why people say that governments aren't more willing to allow real estate prices to decline is because their voters have got this huge net worth built up into asset prices. Older people are more probable voters. Younger people that are first-time home buyers or renters are not. I heard one statistic, like something like 80% of the people over 60 vote, and under the age of 20, it's the reciprocal. It's only 20% of the people vote, and so therefore the preponderance to vote is skewed dramatically to older people. Those older people have owned homes for a while, and the asset price inflation has dramatically benefited them. Isn't that a real risk for governments?
Absolutely, it is, and I think you've hit the nail on the head there, Brian. One of the big problems that a country like Canada faces, and it's not just a question of age, it's also a question of the fact that long established rule in liberal democracies is that property owners are more likely to to vote than renters, precisely for the reasons you say. They have values, assets whose values they want to defend. So it is a huge dilemma for a government. The question is, does anybody have the political courage to stand up and say, this has got to stop? You know, this is damaging our long-term prospects. It's damaging the prospects of younger people. You know, it's going to hurt us in the long run. What do we do? Do we just try and get to the next election, or do we try and have a long-term vision for the country? And unfortunately, and you know, it's a problem in many Western democracies, but it's particularly acute, interestingly, in the Anglo-Saxon democracies. It's even worse in Britain, where, you know, there's an actual positive sort of campaign by the current government to almost stop house building altogether, simply because that is the surest way to ensure their voters see the value of their property portfolios go up. It's not quite that bad in Canada, but I think you're absolutely right. But again, I would repeat the point, Brian. If you're a property owner, let's say you're in your 40s, you have an income coming in, the value of your property has gone up.
John, are you there? Have we lost you again? Hello, hello. Go ahead, John.
There is another side to this, of course, which is that while we always focus on people will be unhappy because their property loses 10 or 15 or 20 or 30% of its value. But if I'm not mistaken, first off, that means you know, if you get a revaluation, your property taxes stand to go down. If you're not planning to resell your house anytime soon, there's no particular advantage of a surge in asset prices. You know, if you're living in the house and you're going to live in the house for the next 15, 20, 30 years, all it would mean is that your mortgage payments might go up. But my argument is that if you're earning an income from work and your wages are keeping pace with the rise in interest rates, that would be manageable as well. So I'm not entirely sure that everybody stands to lose from a decline in property values. I think that working people with a mortgage are going to have to tighten their belts, but I don't necessarily think they're going to stand to lose. It's the people who are perhaps living off the rental income who would stand to lose. And I think the question then is, well, which group are you going to try and keep happy? And you know, it's going to be a tough choice. It's no question. You know, I mean, the economy, the way it's been running for the last period, you know, the last 10, 15 years, has definitely favored asset owners over workers. Written elsewhere, because of changes in global labor markets, workers have more bargaining power. And if you keep driving up asset prices, inflation will go up because they're going to be able to match those increases in the cost of living with wage demands until you try and create a recession. But a recession, frankly, it would take such high interest rates that it would kill all sorts of economic activity. They're going to have to find a better way to solve this problem.
So you don't think that there is a probability of recession? You think that the high interest rates that we're currently enjoying worldwide aren't going to create that recession that people are worried about?
I have not expected a recession at all, Brian. All along, I've said we might get, you know, we might sort of bump along for a little while close to the bottom, but I don't expect there to be a recession in any countries. I mean, there will be short recessions in some European countries. There will be a short recession in Britain, but I don't expect either the US or Canada to enter into a recession. Now, I will add one qualifier to that statement, that the events of the last week have created a great deal of uncertainty that wasn't there before. So the possibility of a policy error, you know, triggering some kind of recession is now on the agenda the way it wasn't 2 weeks ago, right, entirely because of the ineptitude of, you know, the public officials in this respect. But the structural conditions in the economy, I would say, are fairly favorable to continued growth. Mainly that very wage growth I'm talking about is enabling demand not to fall down in response to interest rates. It's contracting, but it's not contracting as sharply as the sort of conventional models have been predicting. So I remain fairly confident that Canada, unless there's a major policy error, Canada will stay out of recession this year.
Let's come back to housing prices just for a second. One of the arguments that I've had with numerous different people is that while they may feel richer as housing prices go up, they're not really richer, because if they sell their house and they still want to live somewhere, they're going to have to pay just as much more for that new house. And that, frankly, if housing prices go down, that might feel bad, but the reality is the house they're going to buy when they sell their current house has also gone down. And so therefore, when you're only richer if only your house goes up and every other house stays down in value. So, maybe some people that have been able to cash out of their home equity and move elsewhere have a potential benefit. But assuming that you're going to sell your house and move somewhere else into a comparable house, you're not any better off at all, are you?
That's true of homeowners, and I keep coming back to this point, Brian. I think that we keep talking about, homeowners are going to get hammered, but I don't think they will, for the very reasons you say. Who would get hammered? Who would stand to lose is the person who's flipping property, buying property, fixing it up, and then reselling it at a substantial markup, because they're not living in the property. They have their own property they live in, and then they're buying these investment properties. They're the ones who will take a hit from this, and that could be a pretty substantial hit to a significant number of people. But I would also suggest that those are probably people who should be in a position to absorb that shock. If they aren't, I'm not, that's where Schumpeter would come in. If they aren't, if they've actually been managing the money that they make off these property sales so badly that, like the depositors of, Silicon Valley Bank, they say, oh my God, the sky is falling because I have to take a 2 or 3% haircut on the value of my deposit. We have to question, are those really businesses we want to bail out anyway?
Well, maybe we'll have socialism for property flippers now.
That is the risk, and it's not going to do the economy any good.
We're chatting tonight with John Rapley, economist who's written very frequently in the Globe and Mail. He's been critical of regulators. You know what we're going to do? We're going to take a break for 2 minutes and come back with some concluding comments from John. And I'm going to ask him, should we have faith in these regulators and our central banks? Because it seems that they've made a lot of mistakes, and John's elaborated on numerous of them. We're going to come back in just 2 minutes. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. I'm having a really interesting conversation tonight with John Rapley. He's an economist, he's a columnist, he's a professor, and he runs a consulting company in economics. And we've had an interesting conversation where, John, you've been very critical of central banks and regulators in numerous ways. You've said that by keeping interest rates low and quantitative easing over the course of, really, frankly, the last more than a decade since the Great Recession, we've led to this asset price inflation, primarily in stock markets and houses. You say that the increase in houses has been unproductive. It's robbed the economy of money that would be invested in startup companies and more innovative companies and increased productivity, and it's increased the rents for any of those people that did want to start up those companies. And now you're talking about how regulators with the Silicon Valley demise have made a mistake and have socialized the banking sector to a certain extent for the rich and for the big depositors, rather than allowing anyone over $250,000 to suffer a loss. Should we have confidence in our central banks, in our regulators, or should we fire them all, as one of the people in politics in Canada has been arguing? What's going on? What do you think we should be doing?
Well, I'd split them into two groups there: the regulators and the central bankers. Although, of course, the central bank has a regulatory role. I think regulation in Canada has actually been pretty good. The kind of egregious mistakes being repeatedly carried out in the United States, and this is something that goes back a very long way. I mentioned Larry Summers earlier in the conversation. Back in the 1998, during the Asian crisis, he talked about crony capitalism, and they had to wipe it out in East Asia. But as soon as crony capitalism manifested itself just later that year in long-term capital management, he was the first to say we have to fully bail it out because it's a systemic risk. So, one man's crony capitalism is another one's, sort of dynamic or systemic risk. And that's why I say people like that, I think we should stop listening to. I think the regulators in the United States have done a bad job. They've been doing a good job in Canada. Canada has a good, well-regulated banking system. It's well capitalized. One of the advantages of having a smaller number of bigger banks. I do think the Bank of Canada has completely, and for a very long time, it looked great. They looked like heroes back in the days when everybody, it was just property prices going up and inflation was low. Now that it's the reverse, inflation is up and property prices are falling. They've gone from heroes to zeros. Well, they're the ones who, they've got a mess they've made. They're going to have to clean it up. Unfortunately, that's going to fall on everybody else's shoulders. But for the moment, at least, I'd have more confidence in Canada's regulators. I think they've always done a fairly good job, and I think we can trust in them. The Bank of Canada has to restore its reputation, quite honestly. And I think finally, I would say governments. There's been quite a lack of imagination, I think, in governments in the past. Their solution to the housing crisis just seemed to be throwing more money at it. Making it easier to get a bigger mortgage and that sort of thing. And that doesn't solve anything. That's not dealing with the problem at all. I think if the country is going to talk about creating a growth agenda, I don't see any way to do it that won't have an impact on this very outsized sector of the economy. And I think, they just have to start facing up to that in the conversation.
So this is probably the subject of a whole nother show at some point in time, but productivity growth has been anemic in Canada. Real gross incomes have been flat for some people think a decade. What's the solution?
Well, partly is acceptance. Productivity growth has been declining, or the rate of productivity growth has been declining across G7 economies for the last 40 years. So that's a long-term trend. It has deep structural explanations. It's not going away. There's only so much we can do. But I think beyond that, I think that the country needs to create a more favorable environment for people to start businesses, or for people who want to start businesses to be able to get those businesses off the ground. And I think it needs to do more in supporting research and development. And I think it needs to reduce the cost of doing business. And that does start with the property sector. I think that's a significant part of it. I mean, if you look at some of the countries around the world which have very dynamic economies, they're ones which have generally got a handle on this particular issue and kept property prices from rising much faster, if at all, than incomes. We've allowed that to get completely out of whack in Canada, and that is one of the prices we pay for it. We're not going to be able to tackle productivity growth until we deal with that. We shouldn't be putting money into houses. We should be putting it into new technologies.
We shouldn't be putting money into houses. We should be putting it into new technologies, venture capital, innovation, the growth sector of the economy. Fascinating conversation. John Rapley, thank you so much for joining us. Really appreciate it.
It's been a pleasure, Brian. You have a good day.
That's our show for tonight. Thanks for joining us, everybody. Really interesting.